Hi guys, Zamisa over here with a new video. I usually have a very cool intro. Yeah, that's it. I don't have a reason why I don't have an intro. Might as well get down to it. The biggest issues in Forex trading are structural, behavioral, and systematic. But let's focus on market noise. FX markets are heavily noisy on lower time frames. Price often moves due to liquidity flows, stop hunts, or short-term positioning rather than clean trends. This makes retail-style technical setup less reliable than they appear in hindsight. Unfortunately, the market is intentionally designed to be adversarial at low time frames. Fixing it doesn't mean eliminating noise. It means changing what you define as signal and where you extract it from. There are a few real proven ways traders deal with this. The first thing is to stop treating low time frame price as truth. On M1 to M15, price is dominated by liquidity sweeps, execution flows, and short-term hedging. So the fix is conceptual. You don't trade the candle, you trade the context above it. That means high time frames define bias and low time frames only define entry timing. If you reverse the hierarchy, you will overfit noise. The second option is to filter noise using volatility regimes instead of fixed setups. A huge hidden issue is that most strategies assume stable volatility, but FX alternates between trend expansion and mean reversion chop. The fix is to trade only during expansion phases, avoid trading during liquidity compression, and measure ATR range compression. This alone often improves consistency more than any indicator. The third option is to reduce model sensitivity. Retail noise is often just over-optimized entry logic. Traders should simplify entry criteria, increase confluence threshold, and accept fewer higher quality trades. Professional trading is usually low frequency plus high selectivity plus large sample patience. But the bottom line is that the noise is part of the game. You don't remove noise from FX. You build a filter that converts some noise into signal. That's what liquidity models, order flow thinking, and market structure trading are really doing. Now let's turn everything into something you can actually execute, not just theory. First is the bias layer, where you define directional intent. When choosing timeframes, ask only where is price relative to previous highs and lows, is liquidity likely above or below, and are we trending or ranging? Only look for buys in a bullish structure and only look for sells in a bearish structure. If you skip this, you're trading randomness. The second layer is where you want to trade. You're looking for discount for buys and premium for sells, pullbacks into structure, and areas where traders are likely trapped. Think is price in a place where smart money would enter, not is there a pattern. The third layer is the execution layer. This is where your entry triggers are: liquidity sweeps, sharp rejection, or a break of microstructure. This works because you're aligning how FX actually functions. Banks need liquidity to enter positions. They create that liquidity via stop hunts. That noise you see equals intentional engineering. So instead of avoiding noise, you wait for it, then trade the move that comes after it.